Welcome back to the Ultimate Credit Spreads Trading System course. This is lesson number 3 where we're going to dive into a bullish market strategy to help us take advantage of bullish markets by trading credit spreads. So let's dive into it. This is from the Credit Spreads Trading Guide and Handbook, which walks you through how to be a profitable credit spread trader for free. It gives you everything that I have discovered over 6 years of trading. Again, link down in the description to get free access to just an email, and you get immediate access. Anyways, let's dive into it. So if we look at it, it's called the Turtle Strategy, so let's jump right to that. The Turtle Strategy comes from profiting in bullish and uptrending markets. It's called the Turtle Strategy because back in the 1900s, we had Richard Dennis, who was a legendary trend follower, who took some people off the street who had no experience trading and taught them trend following rules, and they went on to make hundreds of millions of dollars. This is based off that strategy. Okay, what does it look like visually on the chart? Well, as we discussed in the last lesson, if the stock is above this top blue line, then we are trending up, and if we're trending up, that means we're in a bullish market. So that means this trade criteria is met if the stock is above this top blue line. Now again, if you didn't watch lesson number 2, please go back and watch it, but this blue line is simply a Bollinger Band set with the settings of 200 for the moving average and 1 for the standard deviation. Again, it's not as good as what members get as the trending band, but it's close enough. Anyways, let's dive into the specifics. Okay, so if we go in here, you can see that once it is above that top blue line, which is what it says here for criteria 1, then next we need to determine what is this put credit spread going to be structured as. Because if you're structuring a put credit spread, you need to have a stock or a strike price that you sell and a strike price that you buy. So what you do is you go to 97% of the current price. Why is that? Well, it gives us time to go out, but also allows us to follow the trend, put credit spreads in general, make money as the market goes up. So it's a very congruent trade with a bullish market. So what we do is, let's say we were looking at the market at this day right here. The market was trending up. The close for that day, it looks like it was 433.80. Tap in 433.80. Again, we want to be out by 97%, which is going to be 0.97. Then we're going to round up to the nearest whole number. That makes it 420.78, or we round up to the nearest whole number, 421. That means to structure this put credit spread, we're going to go down to 421, and we're going to sell that strike price of a put. Then we're going to buy the 420 for our protection, and that is going to be how we structure this put credit spread. What we also need to know is actually what is our expiration date. So again, we're going to take the current date, whatever that is, add 12 days to it, and then our expiration date will be that next Friday. So again, if we add 12 days and it lands on a Friday, that's good. That's our expiration date. If it's not, if it's a Monday, Tuesday, or Wednesday, then you need to round up to the next Friday, because Fridays are our best expiration days, historically speaking. Now, we need to set this trade up in our broker. We're going to sell the 421, buy the 420. Again, if you have any questions about how to structure credit spreads, I have so many videos on my YouTube for that. But also, you can go inside our membership, and let me show you that real quick, and it'll walk you through the whole process. Now, again, this membership is typically closed, but again, there's a backdoor link for you to get access with if you have this PDF trading guide. Anyways, but as you can see here, if you have a problem placing a trade, just place this trade, select on the broker you want to place, and you can easily walk through how to place the trade. So again, that's all there for you. And again, if you use the backdoor link in this PDF guide, you'll get a free hat, shirt, and 50% off. Anyways, continuing on, so that's how you set up the put credit spread. That's how you place it. If you can collect the minimum credit for that trade, then you're going to place the trade. Again, I'm going to be getting into minimum credit here in a second after we get through all the strategies, but it's listed down below in this document. Essentially, the minimum credit is what credit do I need to ensure at the bare minimum that I'm collecting so that I profit long term, right? Because credit spreads have losers and winners, and if you can collect enough money up front, then you're going to be profitable long term no matter what your win rate. However, if we're looking at a back test of this performance, the True Turtle Strategy has one of the highest occurrences. Why? Well, because the market long term is trending up. It's above this blue line more than it isn't. And because of that, you can trade this strategy a lot. So that's why it has one of the largest return rates. You can see here an 87% win rate. Again, we're trading roughly about a 25 delta, 30 delta. So that means that by default, we have a theoretical win rate of 70 to 75%. But when we trade with the trend, as mentioned in lesson number 1, we have a higher win rate. Thus, we have an 87% win rate, and we have a 33% annualized return. And that's the beautiful part of trading a simple system that works. So guys, I highly recommend you press that subscribe button, turn on the bell notifications, because I'm coming out with a new video every single day for this lesson, for this free course. And trust me, you don't want to miss out if you want to become a better, more profitable, more consistent trader. All right, guys, see you in the next lesson.